All right, campers, welcome to Biggerpockets Live. This is Paul Moore. I am so glad you're here. Welcome to those of you on YouTube Live. Welcome to those of you on Facebook Live. What I need someone to do is comment and tell me if you can hear me. My mic is on. I just need someone to tell me if I can be heard. So, hey, this is Paul Moore. Hey, Ramsey, great to see you. Thank you. Let me know if you can hear me okay. Tom Peters says, hello from Cancun. Hey, Eddie Lee from Florida. Great to have you. Baruka, Michelle, Brian Denegi. You can hear me. Sounds great. All right. That's great to know. Thank you so much. Hey, Delone, Matthew. Wow, big crowd. Rowan, Jeanette, Galicia. Thank you. So, hey, I can see your comments coming in. I want to warn you, if you're on Facebook Live, there may be a little delay getting comments back to you. I'm having a little trouble with my scrolling on Facebook Live. So anyway, but we're so glad you're here. We're going to talk today about how to become a multi-millionaire. And so I'm going to give a few minutes for other people to get logged on. Hey, Wahung. Hope I said that right. Chiagozi, Jonathan Slater from South Carolina. How are you? Brian Dale Horn. You should turn the gain down on that mic. Thank you, sir. I really appreciate that. Hey, Brian, would you let me know if this is better? Maybe I'm just talking too loud or too close to the mic, but let me know if this is better. I'll look for your comment there, Brian. So we are on Biggerpockets Live. We are on Facebook Live. We are on YouTube Live. And if you're on Biggerpockets, please let me know. If you're on the Biggerpockets site, let me know if that works well for you, Brian. It's still distorting a little bit. Lee says it sounds good. Okay, so if anybody else has any comments on my volume, that would be super helpful. Hey, Mario. Hello, Tony Peters. We all want to be where you are. Well, I am in Roanoke, Virginia, actually near Lynchburg, Virginia, in the Blue Ridge Mountains, and it's awesome. Hey, Rowan. Hello from Greenville. Hey, Greenville is one of my favorite towns. We're actually looking to buy multifamily in Greenville. So if you got any ideas, please reach out to me on my email or on Biggerpockets. Hey, Chigozi. And our goal today is to get 50 shares. So if you want to be a millionaire, and if you know anybody else who does, would you please share it? We'd love to get 50 shares today. Brandon Turner's got the record with 90 shares last I heard, and we're trying to get at least 50, a little over half on the way to him. So please share it, and that would be awesome. Ron says, sounds good. Keone, sounds good. Hey, Brian, still sounds a little distorted. Gets close when you're close to the mic. Sorry, it's not unbearable, just a little distorted. Okay, I'll try to sit back a little bit. Hey, Linda, nice to see you. We are so glad you're here. We got a lot of folks on YouTube and a lot of folks on Facebook. Thank you for joining us today. Did you all hear the big announcement at Biggerpockets today? If you haven't heard, I'm going to tell you in a minute. But anyway, we're glad you're here. We're going to talk today about how to become a millionaire and never pay taxes. That part was a joke. But you can become a millionaire and minimize your taxes through real estate investing, and it's really incredible. What I've done today is I've got a spreadsheet set up. Hey, Lee Pitts from Mississippi. Hey, Linda Vincent from Florida. So glad you're here. I've got a spreadsheet set up, and I'm going to actually allow you all to tell me how much to invest, how long to invest it for, and we're going to see if we can figure out how much your assets would grow to. So I've got my lovely assistant Hannah here, and you can't see her, but she's actually helping me out with the Facebook questions since the scroll's not working. And Hannah, so far I'm good on the scroll. You don't have to print anything out yet or bring it over. Hey, thanks for sharing, Brian. Okay, so Matt Collins says can't share on YouTube. Oh, bummer. Hey, from Dublin, Ireland. Hey, Jonathan. Thank you so much for joining us. Caliente in Arizona. I heard it's really hot. My daughter lives in Redding, California, where it's 113 degrees in general, but as you guys might have heard, it's a lot hotter than that now. I'm not making a joke of that. They're having horrible wildfires. And so our prayers and thoughts go out to Redding, California, and everybody there. So hopefully nobody here is experiencing wildfires. Kia says, hi, Biggerpockets. Can you please sort out your YouTube videos into playlists? It'll make it a lot easier. Thanks, Kia. Hannah will take note of that, and we will give Biggerpockets that information. Eddie Lee says, hello, Hannah. Hey, from Conyers, Georgia. Hey, Larique. I put that little accent in there, but I'm not sure if it's right. Speaking of which, hello from Ottawa, Canada, says David Lemieux. How do I say that? Hey, David. I can say David. Hey, Matt. So glad you're all here, and we're going to get started in just a minute. But before we do, did you all hear what the announcement on Biggerpockets today? Biggerpockets has announced that they are adding a whole bunch of features if you're a pro member. So if you're a pro member, you're going to get a bunch of stuff worth thousands of dollars. First of all, you're going to get access to Better, which is a direct conventional mortgage lender, $1,000 off your closing. Roofstock, tenant-occupied. If you have tenant-occupied apartments, you can save $500 on their stuff. There's a national bank, NBKC, who's offering 0.25, 25 basis points off your mortgage, which is an awesome $200 in closing costs. Sense Financial, which is a 401k or IRA you can use for real estate investing, $300 in savings, 30% off setup fees. One of my favorites, Neighborhood Scout. I don't know if you guys have used Neighborhood Scout, but we use it a lot. Hey, Kevin. Hey, Kia. Hey, Michaela. Thank you so much for joining us. We use Neighborhood Scout a lot. Our company, Wellings Capital, uses Neighborhood Scout to figure out if we want to look at further at a multifamily asset. We look at it, we use it to decide, before we do anything else. I mean, the first 5 minutes we hear about an asset, we actually use neighborhoodscout.com to check out the incomes in the area, the school systems in the area, the renter mix, the military people in the area, all kinds of different demographics. The crime score is the first thing we hone in on. You should always, we believe, Wellings Capital believes that about 2/3 of your success in multifamily investing is going to come from the getting a great property manager and being in a great location, okay? 2/3 of your success. So Neighborhood Scout's really important, okay? And so we've been paying for Neighborhood Scout for years, and now I see as a pro member, I could have got a discount, 20% off your first month or your annual payment. Now, if anybody wants to join Biggerpockets Pro, get a Biggerpockets Pro membership, you're going to have to ask, and I can give you a discount code, but you have to ask for it. And I'm going to ask that you give us a thumbs up, a like, a heart, whatever y'all do. Just give us some kind of a thumbs up. Hey, Nicole, great to hear from you from Oregon. Does that say boring, Oregon? Did you write that right, Nicole? I'm sorry. I'm sorry. I know there's a Hell, Michigan, and now I found out there's a boring, Oregon. So there really is. You can look it up. I used to live in Michigan. But seriously, Rent-A-Meter. Some people say Rentometer. I don't think that's right. Home Advisor, $500 with savings with them. Sense Financial. Hey, Will Dalton. Hey, Joe Berg. Hey, Robbie. Thank you for the likes. We appreciate all the likes, all the shares, all the hearts, all the smiles. And I'm actually going to tell a joke if I get enough shares, likes, smiles, shares. I know you can't share on YouTube, but if you would just give me, a thumbs up or whatever. If I get a few more, I'm going to tell a joke here. I know you really want to hear a joke from the 70s, right? Hey, Kia. Kia says, can I have that discount code? Okay. So I'm going to have to look it up, and we still have people coming on. It's almost 10 after. Looks like it is. And so we are going to get started. I should have had that discount code, and Zach is probably going to be upset with me. Okay, here we go. This is a discount code to get a savings on your Biggerpockets Pro membership. And I just told you there's amazing new reasons to get involved with Biggerpockets Pro. I've been a member for a while. By the way, if you're in any state in the U.S., they have forms, contracts, landlord documents, lawyer-approved forms you can use if you're a Biggerpockets Pro member. So it's awesome. Hey, Jonathan, Geronimo Valdez. Hello, Nick. There is a boring Oregon, yeah. Oh, I see Nicole said that too. Okay. Well, it's better than being in Hell, Michigan. All right. BP Pro code is Let's Invest. It's in all caps. LETSINVEST. Let's Invest. So we're going to encourage all of you to join Biggerpockets Pro if you haven't already. I know you're a member of Biggerpockets. But Biggerpockets Pro code is Let's Invest. All written out, one word, all caps. LETSINVEST. All right, let me see if there's any more amazing savings here from joining Biggerpockets Pro. AirDNA. What's that? Interactive tool to analyze the global short-term rental market. 30% discount for the first 6 months. And that's with AirDNA. So you get all that by becoming a pro member with Biggerpockets. So we're going to recommend that you do that today. And I'm going to take that off my screen so we can get started here. Hey, Nick, you're welcome. David, thank you. All right. So NS Equity says first option agreement ever. It's on a $2.3 million Palace. Is 2.2 a good price with nothing down? Inez, I don't know. I just don't know enough about it. I would check with a local real estate investor. Someone says you can share on YouTube. Thanks, Kyle. Alicia, LOL, yes, we do. I guess that means you want to hear a joke. Okay, so we're going to get started here in a second. We're going to talk today about how to become a multimillionaire. And my son is flipping large timber land, large pieces of farmland, large property. And we were driving around the other day, and I was like, in my head, I was doing calculations on what it would cost. Like if he invested like 100,000 of his profits this year, he's 25, what he would have by the time he's 55. And I started doing the math, and I've been a real estate investor for years. I've never actually done this exact calculation. I was blown away. I was able to figure out and show him how you could take $100,000 and over 30 years without a ton of risk, I promise, and I'm going to show you in a few minutes, you could turn that into $5 million. And it sounds ridiculous, and it sounds like I'm lying, and I'm probably going to get some people. I had somebody the other day said that someone wants Brandon Turner's phone number. I can't give that out. But hey, Nilofer, thank you for joining. Hey, Robbie from Milwaukee. But I know some people are going to criticize me and say that's ridiculous. That's way too high risk. You're lying. Okay, but I can show you on paper how to do this. And if you reach out to me afterwards, I will try. If you reach out to me on Biggerpockets, I'm going to try to refine the spreadsheet a little bit and share it with whoever wants it. Okay. Hey, so Geneva Foster Paul is who spoke about Airbnb. Yes, that's right, Jeff. Hey, my parents have about $125,000 in equity. Should we refinance or go in a HELOC? I would use a HELOC. It's simple. I don't know all the details about the refinance, so I don't know what your new interest rate would be. Hey, Lisa Marie Zimmerman. Hey, Carlos. Hey, Kim. But HELOC would be the easiest path to getting that money out and being able to invest it. So we're going to talk today about how to take $100,000 and turn it into $5 million. Now that's scalable. So if you have $50,000, you can turn it into $2.5 million. And we're going to also see the horrible ravaging effects of taxes. And we're going to talk about how to avoid taxes, but only very briefly, because I'm going to do another talk on Saturday, if they don't fire me by then, for telling this joke. About how multifamily and other commercial real estate investors save on taxes. I'm going to give you a little teaser for Saturday or for the next session, whenever that is. And I had a friend who said he could take $20 million and turn it into $310 million in 20 years. Okay, 20 million and turn into $310 million portfolio in 20 years, and it would throw off $138 million in income along the way. And the investor, if crafted right, would have to pay virtually no taxes. I kid you not. He said if the American public knew how little commercial real estate investors and syndicators pay in taxes, there'd be another tax revolt on our hands. And he proved it to me. He showed me the math. He showed me a spreadsheet. Well, today I'm going to show you how to take 100,000, turn into 5 million, and we'll talk about taxes on another day. I can just tell you a little bit about that today. But I promise. Oh, thanks, Iris. Thanks, Lisa Marie. Oh, I forgot the joke. That's right. Thank you. Okay. You can be a millionaire and never pay taxes. Yes, you can be a millionaire and never pay taxes. You too can be a millionaire and never pay taxes. You say, Paul, how can I be a millionaire and never pay taxes? Well, first, get $1 million. Second, all right, I thought it was kind of funny. Well, anyway, I guess the rest of the joke would be tell them you forgot to pay taxes on the million. But a lot of people wonder, there is actually a point to that. I don't know what it is. No, a lot of people wonder how they can get $1 million. If I only had $1 million, I could turn it into enough money to live on and have a passive income stream. Somebody was telling me once, you need about $2 million to generate enough passive income to live on the rest of your life. And so how do you get from where you are to, let's say, 2 million or 4 million or 5 million or even more? And we're going to talk about that today. Now, it's no secret that the ultra wealthy, thanks for all the smiles and hearts and thumbs ups and LOLs. Please share this and give us, thanks you. Yes, Victor, you're right. It's a goofball joke. That's actually an old Steve Martin joke. But it's no secret that the ultra wealthy have made their fortunes. A lot of them, a huge percentage of the Forbes 400 has made their fortunes in commercial real estate, and a whole lot more now that have made their fortunes otherwise perpetuate that by using commercial real estate. And we're going to talk about that today. Through real estate investing of all types, you can perpetuate a fortune. You can pass it down to the next generation. Often you can do that without any taxes on it at all, which we'll talk about in the next session. But I want to talk today about the not swinging for the fences. Now, there's a lot of ways to make money. People have talked about making money in Bitcoin. People have talked about making money as an angel investor. I talked to a guy the other day who bought Facebook when it was $18 a share, and I think it peaked at $200. Don't criticize me if I'm wrong, but I think it peaked at $225 a share. They made 10x their return. So one way to make a fortune is to pick stocks really well. The problem is, who is going to know who the next Uber is? Who's going to figure out who the next Airbnb or the next Facebook or the next Google? It's not easy to figure out who it would be. And the problem is, it's very, very easy to lose all your money. So if you took $100,000 and plowed it into a high risk, potentially high return investment, it's easy to lose all that. And I can tell you, I lost $100,000 in one investment in the year 2000 or so, and I've talked about that elsewhere. I invested with a guy who had a 2 to 3% monthly return, and he was actually paying that return. I was getting my statement every month. It looked really good. Something seemed wrong, and I went to meet with him to talk about investing another $100,000, and I left there kind of scratching my head going, well, first of all, I'm not going to invest another 100. Something felt wrong. And I wish I would have followed my gut. And I wish I'd have pulled out the 100,000 plus the interest the gains I had made, but I didn't. And that guy is in the federal penitentiary now for 150 plus years. And he still not tell the FBI where he hid the $2 million that he built 2,000 investors out of. What did I say? Did I say 2 million? It was 2,000 investors. It was $18 million. So if you want to risk all your money in the next Facebook, Uber, Bitcoin, whatever, go ahead, but realize you're probably gambling. Now, there's a difference between gambling and investing. I spent years thinking, hey, I'm investing. I'm an investor. And I thought it was pretty cool to be an investor. But I realized later I was gambling. I was actually speculating. I wasn't actually investing, because investing is when your principal is generally safe and you have a chance to make a return, But gambling is when your principal is not at all safe and you have a chance to make a return. And more often than not, speculating and gambling, you will lose all your money. And so the uber wealthy know this. And honestly, they have some system set up to make sure that the people who are not wealthy stay that way, and they are taking their money. There's proof that there's all kinds of things out there that the large brokers and large investors do to make money in a zero-sum gain, if you know what I mean, from the smaller investors. And I've got friends who have researched this and proved it, but that's not our topic for today. I'm encouraging people to get into something with a much lower risk and a stable, predictable return. And often that's real estate. Now there's a measurement for this, and it's called the Sharpe Ratio. You can look it up. It's SHARPE. The Sharpe Ratio is a ratio of the return divided by the risk. And the risk is defined as the standard deviation of ups and downs of that asset class. And the return, of course, is the return. The return includes three measures. It's the cash-on-cash return. It's the principal pay down over time, and it's the appreciation of the asset itself. And you take that return, divide it by the risk. The Sharpe Ratio is 400% better than the stock market. Now, it changes every year, changes all the time. But in the 30 years that we looked at, ending fairly recently, the stock market had a certain Sharpe Ratio. Commercial real estate, all of it, that's office, retail, manufacturing, self-storage, multifamily, one more I can't remember. They all are much, much higher than the stock market. But multifamily in particular, and even more, storage units, self-storage, are like 400% better. It's safer. But stocks sometimes go up much more, but they also go down much more. And there's all kinds of statistics. Did you know the multifamily foreclosure rate of Freddie Mac and Fannie Mae loans during the recession was like 0.8%? Private banks were as high as 8 or 9%. And Freddie Mac and Fannie Mae on single-family homes was as high as 4.6%. So it was many times higher. And now the multifamily foreclosure rate with Freddie Mac is almost zero for many years. I mean, almost zero nationwide. So first of all, that tells me that they're doing a phenomenal job underwriting. I'm serious. And number two, if they underwrite your deal, if they believe in your deal, it's very, very likely that you will have a good deal, a profitable deal. But the risk and return ratio is something really important. A lot of people say high risk, high return, low risk, low return. That may be like about half true. So low risk almost always leads to low return. Okay? High risk can lead to very high return or losing all your money. And that's what we're trying to avoid in real estate investing. Okay? So there's ways to invest in real estate that are very high risk. But overall, I'm talking about investing in real estate in a way that's not so high risk. It might take on some risk, and this is what we're going to talk about today. If you just joined us, I see some people did. We're talking about how to take $100,000 and turn it into $5 million with low hassle, limited risk over about 3 decades. And we're talking about how the ultra wealthy do it and how they perpetuate their fortunes. Now, the problem is the ultra wealthy do it this way, but you're not invited to their party. I'm sorry. I'm not either. I'm not invited to their party because there's a thing called barriers to entry. All right, somebody asked for that code again. It's Let's Invest. If you want to join Biggerpockets Pro, it's LETS INVEST. Let's Invest, all caps, all one word. You can join Biggerpockets Pro for a discount. But you're not invited to their party. I'm sorry. I'm not invited to their party either, so don't feel bad. The big guys, the big investors have erected, intentionally sometimes and non-intentionally, large, significant barriers to entry to keep us from investing in these large commercial real estate deals. Okay, so I'm going to go over the barriers to entry today that keep investors like us out of large-scale commercial real estate. I got an MBA from the Ohio State University, and we talked about barriers to entry. Warren Buffett calls it a moat. He said every great business must have a moat erected around the property. You know, the moats around the castles in England in the old days, they actually were erected around the property to protect it or keep it safe. Well, every great business should have a moat around its property. We have an apartment complex in Lexington, Kentucky. Anybody inside Lexington knows that there is a large moat around Lexington, and that is the horse farms, that they will absolutely not allow development in these horse farms. So the apartments that are inside Lexington right now, though they're not fully insulated because there's a little bit of land to build on there, and you can, of course, tear things down, and they do that. But overall, Lexington has not for decades been expanding like a lot of other cities, like Charlotte or Dallas or Houston. I know Lexington's a lot smaller, I get it. But there's a moat around Lexington. And there's all kinds of ways you can create moats around your business. I highly recommend it. But the problem is we're on the outside of the moat when it comes to large-scale commercial real estate, which is where the risk-return ratio is low, the profits are predictable, stable, and generally higher than other asset classes, and it's a way to perpetuate your fortune. So let's go over the barriers to entry. Like I said, I got an MBA, and they talked about creating moats or barriers to entry. Barrier to entry number one, cash. How big is your piggy bank? If you want to invest in large-scale commercial real estate, let's say multifamily, you need millions of dollars. I mean, you need millions of dollars in net worth, and you need millions of dollars in the bank. Here's why. Number one, you need a down payment, okay? Now, you might be able to get friends and family involved in that, and it might work, or you might have that kind of money sitting around. But number one, you need a down payment. Number two, if you're going to get a large-scale lender to back you and give you debt, you need to have liquidity. So the large-scale commercial lender is going to want to see you have, say, enough in the bank or liquid in stocks, bonds, etc., to pay for about 6 to 12 months of the mortgage payment. Now, if you're talking about a $10 million mortgage, for example, that's a lot of money. So you have to have liquidity. Third, you have to have high net worth. One of the reasons Freddie Mac and Fannie Mae do so very well, and I said earlier they have virtually no foreclosures in the last several years in multifamily, is that they only loan money to people with very high net worths. Let's just say, for the sake of this discussion, almost 1x the loan value. In other words, they want you to have a net worth for a $10 million loan of about $10 million and liquidity of, let's just say for the moment, $1 million or $2 million, okay? Maybe more than that. And I did say 6 to 12 months of the loan, but they actually want you to have more liquidity than that for other reasons. So I'm not going to get into that now. It's finer detail than some of that I don't even know exactly how their formulas work, but they're there, trust me. So number one barrier to entry, the reason you're not invited to their party, number one, is cash. You need a lot of it. Number two is the loan qualifications, and I just mentioned that, okay? To be qualified for the loan, you not only have to have liquidity, you not only have to have high net worth, you have to have something called experience. They have to be absolutely confident that you have a team in place with their names on the dotted line and that you know what you're doing. Experience required. Okay? Can you call me Captain Obvious? Someone call me Captain Obvious, or give me a like or a smile or heart or something. But seriously, they want to know that you have the money and the expertise to run this. Okay, thank you guys. Thanks, Nate. Thanks, Tech. It may sound obvious, but they don't want you to default. And you don't want to default either. So you have to have a great team in place, and you have to get the experience. Now, there's an ad from the 70s. It was a little whiny kid who was going for a job interview, and they said, "We're sorry, son. Experience required for this job." The guy had a big cigar, and he was sitting with his feet up on the desk. And I could do that right now, but I'm not going to. But seriously, the whiny kid he turns to the camera and he goes, "But how do I get that experience?" The question of the hour is, how do you get this experience? And if I have time toward the end of the show, I'm going to tell you 7 ways to get the experience. But for now, I'll tell you, you need a lot of experience to succeed and to get the loan qualifications. So that's barrier to entry number 2. 1 was cash. Number 2 was qualifying for a loan. Number 3 is brokers. Who do you know? It's really, really important to know a broker, because in the commercial real estate space, unlike residential, did you know in residential, they have to give every single offer to the seller right up to the day of closing. Even if there's already a deal that's already in place, you've got an accepted offer, you've got, let's say, a 2-month runway to closing. Every offer that comes in, even if it was for $10 on a property, that would have to, by law, be presented to the seller, at least in Virginia and every state I'm aware of. Commercial brokers have completely different rules. They want to know that you can put gas in their BMW and food on their table. And if you're not absolutely looking, smelling, acting like somebody who has the wherewithal to close on this loan, even if you're $1 million above the next closest bid, they will often not present it to the seller, or they'll tell the seller, here's the offer, let's not do this. I don't know this guy. So the point is, it's who you know, it's the experience you have. Commercial brokers have a massive barrier to entry for people who are not experienced or who they don't think will close, okay? I could leave it at that. I'll tell you a little bit more. I was in Houston once trying to find land to build a Hyatt hotel. We'd already built one Hyatt hotel with a partner in North Dakota. That's another story. I've got a podcast, by the way, called How to Lose Money. So if you haven't tuned into my wealth building podcast, go check it out. It's How to Lose Money. Or give me a thumbs up if you've heard the show and you like it. But we built a Hyatt hotel. We were trying to build another one in Houston in the Texas Medical Center district, and we could not find land. We finally found land. The broker we presented a full price offer on this land, and the broker did not present it to the seller. I found this out weeks later, and I thought, doesn't he know who we are? Guess what? That was exactly the point. He didn't know who we are. He had no idea if we had the credibility to close. A month later, he ran into a friend at a country club who knew us, and they said, oh, yeah, those are the guys with the real deal. They did this and this and this. And then all of a sudden, he calls me back and he said, do you still want to make that offer? See, the brokers want to make sure you have the ability to close, and they're not just going to allow you to get in to the club just because you make a high offer, or just because you have the money, or just because of a lot of other factors. So there's these barriers to entry. We're talking about cash, loan qualifications, brokers, by the way, sellers as well. The smart seller will not sell to somebody they don't believe will close. And number 4, economies of scale. Go big or go home. Economies of scale is basically the thought that if you do what I'm talking about at a duplex level, a 4-plex level, a 12-plex level, that's awesome. Hats off to you. Great strategy. That can work. But a lot of the economies of scale we're talking about here that the super ultra wealthy use to perpetuate their fortune come at the much higher level, the $5 million, the $10 million, the $20 million deal. Did you know that 93% of commercial multifamily, and that's multifamily above, let's say 70 or 80 units, 93% of those in the U.S. are owned by companies who own multiple apartments. So there are very few independent operators, or also called mom and pops, running large apartment buildings. Okay, they're 93%. By the way, self-storage, which I'm happy to talk about later or maybe on another show, I think 76% of large self-storage is owned by individuals, mom and pops, 76%. And those are ripe for taking over by an operator and dramatically raising income, raising the value, and raising investor returns. In fact, we're going to talk about that a little bit later. Self-storage, along with multifamily, are my 2 favorite ways that the ultra-wealthy build and maintain their wealth. So let's talk about value add for a minute. And this is where I was getting to a minute ago. You know, you can do some of this with a duplex or triplex, but you know, at a 4-plex level, at 4 apartment units, you become a commercial loan. You become a commercial appraisal. Individual residential or duplex or triplex, they're almost always evaluated based on the other homes in the neighborhood, and they're limited, they're capped by the other houses or duplexes in the neighborhood. The appraisal caps the value of that. But on the commercial side, the value is driven by income. So it's the net operating income divided by the cap rate. And the cap rate is generally the rate of return in that city at that time. Okay? So it's based on income, and that means value add can play an incredible role, a value add strategy in dramatically raising the value of a commercial real estate property, whether it's a multifamily, whether it's self-storage, whether it's other asset classes. Let me give you a very quick example of this. When we took over the apartments in Lexington, Kentucky, I mentioned a few minutes ago with the moat around them, we realized when we made the offer on it that the utility costs were through the roof. The water and sewer bill was over double what it should have been. So what we did is we immediately installed water meters, and we began to figure out there's a huge leak in the pool. By the way, the pool is dropping like 6 inches a day. We said, what are you doing about that? And the maintenance guy said, oh, we just fill it back up. I'm not making fun, but that's what he said. But seriously, there were leaky toilets. We had a leaky toilet over the weekend at this complex. I'm not saying we're perfect yet. The maintenance staff might have missed this. It leaked 2,000 gallons of water over the weekend. Give me I don't know if there's a way to say thumbs down, but boo, bad. And so the multifamily, our maintenance guys came in Monday morning. That was their first priority, to fix that flapper. I got a letter from my local county water, by the way, last month saying, hey, you might have a leaky toilet because your water bill was much higher this month. And indeed we did. We just had this little flapper that was a little off. But by the way, no matter what real estate you have, that should be one of your first priorities is to fix the toilets. Leaky toilets are costing owners and tenants a lot of money. But anyway, we were able to reduce, in theory, when we're done with this process, we're going to be able to reduce the water bill by about, I believe it's $60,000 a year. $60,000 straight to the bottom line, right to the net income. You take $60,000, divide it by the cap rate, and that's about, let's say, 7%. I'm just going to say 6% to make it easy math. $60,000 divided by 6%. Somebody should do that math because I don't have it in my head, but it's 60,000 divided by 0.06. I think that's $1 million. We just raised the value of this property $1 million. It's 60,000 divided by 0.06 for somebody who wants to do the math and confirm that that's right. Where else can you raise the value of a property by $1 million like that just by adding water meters and by fixing the leaks in the toilets? I mean, it wasn't overnight, but it's over a few months. It's really true. Yep, Ben, it's right. And someone said, yes, that's exactly right. $1 million. Thanks, everybody. So let's say in self-storage. Okay, here's something easy. So in self-storage, you can add admin fees. You can add late fees. You can add U-Haul. You can sell tenant insurance. And the total of those, let's just round it up here and say that's about $5,000 a month you can add to the net income very easily when you go into a mom and pop self-storage facility and you add those things, okay? $5,000 a month, that's $60,000. Oh, it's the same number. Well, that was kind of boring. That's about $60,000 a year. So again, if you buy a self-storage facility that, let's say it's $10 million and you can add $1 million in value and $60,000 to your income every year, it's pretty powerful. I'm really sorry it was the same number, but that's another value add opportunity with self-storage. So value add in commercial real estate is extremely powerful, and I write about that a lot in my book. I talk about it. If you want information about my book, you can look on my Biggerpockets profile. So commercial real estate is incredibly powerful. Now, I said I would tell you how to turn $100,000 into $5 million in 30 years, and I have completely failed in that so far because we're about half an hour into my comments, my actual comments, and we haven't started. So let me get that real quick. But before we do, have you joined Biggerpockets Pro yet? Let's Invest is the code. Let's Invest. Okay, to get a discount. There are 7 paths to get into commercial multifamily, and you can probably use a similar list of 7 paths to get into self-storage as well. Okay, I'm going to try to buzz through these, and then I'm going to land on one of them, and then we're going to talk about how to turn the 100,000 into 5 million through this one path alone. There's a lot of others that you can even do other things with. But path number 1, buy a duplex, fix it, do the BRRRR strategy on it, fix it up, rent it out, refinance or sell it, and then repeat it. Okay? Then get a 4-plex, and then get an 8-plex, then get a 20-plex. And I know a guy who took a $1,000 bonus in Arlington, Texas in 1993, and he bought a duplex with it for $27,000. It was a foreclosure. He fixed it up, rented it out, raised the value, sold it for about a $25,000, $30,000 profit. He turned around and reinvested that in a 4-plex, turned around and reinvested that again and again and again. And when I met him 23 years later in 2016, he literally was selling an I think it turned out to be a $12 million apartment complex. All started with that $1,000 investment. So that's one way. It's a long, slow, painful, winding crawl up the mountain. But in 23 years, that's how he did it. So that's one way to become a multimillionaire, is just basically start small. There's a book that I recommend that Brandon Turner loves as well by Steve Burgess. That's Berges. The Complete Guide to Buying and Selling Apartment Buildings. About a quarter of the way into the book, he talks about why it's so powerful to refinance or actually sell and then buy up, and then sell, then buy up, rather than just paying down the mortgages over 30 years. He shows how you could do the strategy of paying down the mortgages over, say, 30 years, 20 years for commercial, and you could have a $2 or $3 million portfolio. I know there's a lot of inputs here, but with the same amount of input, if you don't pay off the mortgages, you just keep refinancing or selling and buying larger and larger, you can actually take that same amount of money. Remember, it was 2 or 3 million by paying the mortgages down. You could turn into 90 million the other way. Okay. So this is definitely a path to becoming a millionaire. Okay. And by the way, I think that graph is a little too aggressive, but even if the 90 million is 20 million, wouldn't you want to know how to turn that into 20 million rather than 2 million? Steve Burgess has got a great book on this, and he should give me a commission, don't you think? But he didn't. I actually don't know Steve. I just like the book. Okay, path number 2, get a job. You probably got on Biggerpockets because you want to get out of your job, right? But you can actually get a job for a property manager, a commercial broker, or an asset management company, and you can learn the ropes that way. And when the multifamily business turns, you can get back to a place where you can buy multifamily again. Right now, it's very, very difficult to find a good price on multifamily or other commercial real estate. But if you get a job, you'll have an inside track and you'll know the business, and you'll have that part of your qualifications done. You'll also meet investors. You'll have all kinds of good opportunities. Path number 3 is to become a multifamily deal finder. Okay. And I think you know what I mean by that. You find a deal, you hand it off to a syndicator, and you ask the syndicator to, number 1, give you a piece of the deal because you brought the deal, and number 2, not a commercial brokerage fee, by the way, unless you're a broker. Or number 2, you ask them to teach you the ropes. Okay. So be a deal finder. Path number 4 is to actually be a money finder. There's all kinds of laws and SEC regulations around this we don't want to get into today. But if you find money for other people's deals, that is a way to get into the business, and it's a way for you to learn the business as well because you want to tag along with that syndicator. Okay, and there are people who do that. There's people on Biggerpockets who are making a living finding money. They've got great connections for other people's deals. Okay. So I think that was number 4 or 5 or something like that. Another way to get into the business is just be a millionaire. Hey, you can be a millionaire and never pay. Oh, I already told that joke. Sorry. Okay, so if you have just a lot of money, let's say you have an inheritance, a family office, you won the lottery, you can actually get into the business and just jump right in. And I know people who have done that. There's definitely, that's definitely a way to do it. So that's number 5. Path number 6, I love path number 6. It's the path I took. It's get a mentor. Now, there's all kinds of mentors available through Biggerpockets, or you can learn more about mentors on Biggerpockets. If you want, you can contact me. I can tell you how to get a mentor, but I can tell you they're not cheap. We're talking paid coaches here. I used to say you could get one for as little as $5,000. Now that guy has raised his rates to about $10,000. So there are several mentors I know that have a fee of about $10,000 to get in. There's some that are like $17,000. I know of one, and then the one I used was $25,000, but worth every penny. I actually just heard about a mentor that's $100,000, and he's got people signing up left and right because he's able to show the value. Now, you want your mentor to be really good, really available. You want them to partner with you on deals, partner with you in finding money in the future when you need it. Finding a mentor is critical. If you want to go that path, finding the right mentor is critical, because there's probably some gurus out there. Biggerpockets has long been against, and they're long promoting that people do not fall in love with a guru who's going to continue to upsell them at those weekend events. I'm sure they teach you some good stuff. Everybody I know who's been through the guru path has been really sorry and has not made a fortune. Okay? Now I'm going to tell you about the seventh path, and the one we're going to concentrate on the next few minutes, and that is be a passive investor. You may say, wait, I don't want to be a passive investor. I want to get out of my job. Well, being a passive investor may not be all that bad. There are people who have passively invested to have made a lot of money. There's two ways to be a passive investor. One's to be not a disinterested, but one way to be a passive investor is to spend a lot of time vetting the operator, vetting the syndicator, really trusting them, and then investing whatever they have. Okay? Then there's a deeper dive. The active passive investor, sounds like an oxymoron. Maybe you think I'm a moron. But the active passive investor actually dives in deep on every single deal. They go to the site. They go to look at the property. They drive around the neighborhood. They're really, really active, and they're really careful. And either way is fine. But if you invest $100,000 with passively into a multifamily deal, you can grow that in about 30 years to about $5 million. And I put together the spreadsheet today, and I'm going to tell you briefly what my assumptions were. And you guys can mock and jeer and make fun and say these assumptions aren't right, but I can tell you they're better. This performance is better than some people are getting, but it's actually far lower than some other syndicators are getting, especially in the self-storage arena right now, where there's just tremendous opportunities. Okay, so here's my inputs, here's my assumptions. I'm going to get a little closer to the camera, and I'm sorry if that offends you. Number one, your original investment of $100,000. Number two, 30 years. We already said that. Now, cycle time. I'm assuming a 6-year cycle time. That means it takes about 6 years to get into a deal. You invest, you let it grow for about 6 years, and you sell. Okay, in other words, the syndicator sells and takes the money and gives it back to you. Okay, the cycle time I'm assuming is 6 years. Now, if you think that's too fast, you may be right for certain situations, but I'll tell you that there are lots of syndicators out there who could actually show you that they're able to cycle time in 3 years. Okay, so it's possible to do 3, 4, 5, or 6 years. Okay, I mean, it's possible to do anything, but assuming 6 years, which is actually quite conservative from what I've seen in this business. Total annual ROI. Now, the ROI, the return, is made up of 3 components. I mentioned this before: the cash, the principal pay down, and the appreciation. Mix those together. The cash is from operations, and you get a total return. And I'm assuming a total return here of 20%. Again, you may think that's too high. That's an annual 20%. I can show you syndicators who are getting 30 and 40% annual total return. By the way, there's also others who are making 5% total return. There's some who are probably losing money. I don't know of any, but there probably are. But I'm using 20% because it is a legitimate percentage that a whole lot of self-storage and multifamily syndicators shoot for, about 20%, and that's net to the investors. Now, the issue now is, are you going to pay taxes or not? And actually, I think we're about to run out of time, so I'm not going to get into that too much. Now, if you take $100,000, please, somebody do the math with me, and I promise you, if you find that I'm wrong, I will confess. But I've got a spreadsheet here, and you know spreadsheets don't lie, right? Okay. I'm kind of being silly. But, okay, so year number one, you put $100,000 in with a syndicator, and it grows 20% a year, and it's throwing off cash, which is part of your return, and you got to assume that cash is used for your next deal, okay? So the $100,000 becomes $120,000, 140, 160, 180, 200, and the sixth year of the time of sale, that 100,000 becomes 220. You might want to write that down, okay? So 220,000. Very easy math. Now, assuming you do a 1031 exchange and assuming you use the cash along the way to reinvest, okay, and obviously you can live off that cash, but that changes the return. You take that 220,000, now you take it and put 110,000 in two properties, okay? Your original 100,000 is all you've actually got in it, but now you've got 220 in year 6, and you put it in 110,000 in two different properties. And that grows by 20% a year, so that takes you, I won't go through all these numbers, but in year 12, that 220,000 became $484,000. And yep, that's right. I just did it in my head again. I'm kidding. But it became $484,000. Okay, now you take that out and you put about $120,000, $121,000 each into 4 deals. By the way, you can plow it into 2 or 3 or 4 or even 1 deal. But the point is, let's just say for the analogy here, 4 deals, okay? So you've got 4 deals with $121,000 each. 6 more years goes by, and that $484,000 grows at 20% each year, and you've got $1,064,800 to be exact. You take that and you invest that in any number of deals you want to, but let's say it's 8 deals, okay? And now 6 years go by. That's 1 million turns into 2.3. 6 more deals go by. 6 more years go by, and you invest that, and you've come out with $5,153,632. Ha! See? I promised $5 million. It's actually better already. $5.1 million, okay? Now, that's a real number. It's actually doable, and there are a number of reasons it could be better than this. And by the way, there are tons of reasons it could be worse than that too. But for the sake of this analogy, for the sake of this example, why did I say analogy? Where's my English teacher? These numbers really work, okay? The $100,000 every 6 years cycles at 20% a year, and you reinvest it, and it becomes $5.1 million. It's kind of like the Steve Burgess example, where the guy creates $90 million in value. I think that they're really, really aggressive, but at any rate. Now, that's assuming you're doing a 1031 tax-free exchange. Hey, Whitney, good to see you. Now, if you don't do a 1031 exchange, that means you're going to be paying taxes every 6 years, capital gains every time. And guys, what's the capital gains rate? Now you're 1,200 years old and dead. Justin, what do you mean? No, it's every 6 years, 5 cycles. That's 30 years total. Oh, well, anyway. Now that just threw me off. So no, the after-tax value you're going to have to use. You all know that if you can reinvest tax-free through a 1031 exchange, it's really powerful. And I'm going to show you how powerful right now. And you may cry when you hear this. If you don't do a 1031 exchange, that same 100,000 over 30 years, not till I'm 1,200 years old, over 30 years grows to not 5.1 million. 3.7 million. So it only grows to 3.7 million, but you don't owe any taxes. So Christopher says, hey, when did Biggerpockets go MLM on real estate? Christopher, I would be happy to try to answer that if I can, but I'm not sure what you mean. I know what multi-level marketing is, but I'm not sure what you mean. So instead of 5.1 million, it grows to 3.7 million. It's pretty good though, isn't it? You take $100,000, you grow it to $3.7 million over 30 years, and your risk, it's actually moderate. It's not huge. It's not like investing in Bitcoin or a high-tech stock or Airbnb or something. So many things you invest in do not actually have the returns that those things you hear about historically. I mean, we all saw Facebook. Mark Zuckerberg lost $16 billion in an hour or a day last week. Commercial real estate is stable, it's dependable, it's predictable, and that's why I love it. Okay? Now, the numbers I just gave you actually would work for other asset classes. It doesn't have to be real estate. It could be something else. But we love real estate because it has incredible tax advantages. 1031 exchanges work for real estate. You know they don't work. The new tax law says they don't work for cars. They don't work for trucks. They don't work for airplanes anymore. My friend with the jet's not going to get to 1031 exchange. Sorry, Barry. But it does work for real estate, and it works really, really well. And there's all kinds of other tax advantages that make real estate amazing. And I'm going to talk about those in my next episode. Watch for it. Watch for it. I think it's going to be Saturday. Okay? So I'm getting tired, and I'm going to take a drink of coffee and look at the questions. Okay. Hey, Tech, thank you. So we haven't got 50 shares yet, so we're looking for 50 shares today. If somebody can share this video, that would be amazing. If you're seeing this after the fact, please share it. Please give us a thumbs up, a like, or a heart, because that means Facebook, YouTube, whoever else is going to give Biggerpockets better ratings, and it'll give us the chance to get this message out to more people, okay? Because who doesn't want to be a millionaire? And who doesn't want to be a millionaire and never pay taxes, right? Okay. That was kind of a joke, but not really. Okay, so I'm going to try to answer as many questions as I can in the time we don't have left. Okay, so Mr. 3 Kings 3, thanks for joining us again. Where do I start with a 1031 exchange? Well, you have to have something to sell for a profit, and then when you sell it, the money doesn't come to you. It comes to a 1031 exchange intermediary, and then they reinvest it in a place you say. It's a lot of work. It's hard. But man, you can save so much money on taxes. It is incredible. So Neela Khan says they need a real estate mentor in Massachusetts. There's all kinds of mentors on Biggerpockets. You guys have heard of Michael Blanc. You've heard of Reed Goosens. You've heard of Jake and Gino. There's lots of real estate mentors on Biggerpockets. I'm not one, and I'm not paid to get one. I'm not paid to be one. What does that even mean? How to be a billionaire. Tio, how to be a billionaire? Well, you just take the 100,000 instead of investing 100,000 to get 5 million. You invest 100 million to get 5 billion. Well, I think you'd have to invest 200 million in all seriousness to get to $1 billion in 30 years using these exact. I can't believe I did that math that quick. I'm going to move on in case I'm wrong. Neelafar, David Lindahl. Okay, don't know who that is. Can you recommend a mentor? Okay, Neelafar is recommending the mentor. Okay, so I don't know anything about David Lindahl, except I have heard that he's an awesome multifamily guy. I don't know. I guess he does mentoring. It's 2 a.m. Tio says, thanks. Invest again in real estate. Matthew, how much do you charge? I actually don't charge anything, Matthew. I'm not selling anything, so sorry. But if I did, I'll tell you what, call me and no, I'm just kidding. Dan Zoom says, I'm about to sell a family inheritance commercial property, and I will use the profit to buy a duplex. How can I dodge capital gains tax? Dan, 1031 exchange is the best way to do that. And if you want to reach out to me offline, by the way, anybody who wants to reach out to me, you can just reach out to me at my profile at Biggerpockets, and I will try to answer more questions or help you with anything I can. I've had, I'd say 24 people at least reach out to me based on my discussion about Airbnb and lease option sandwiches last Saturday. So I'm happy to reach out to you. The Airbnb thing was a strategy to do an Airbnb arbitrage where you don't actually buy anything. You rent the apartment You rent furniture. You might have to buy some furnishings from Goodwill or Salvation Army. You put it in there, and then you rent the apartment out for a huge profit on corporate leasing or Airbnb. And there's a great strategy to do that. And my company's actually bought this $1,000-ish course, and we are actually learning to do this ourselves. So Melissa Acosta says, how do you find lending for 2 to 3 properties when splitting the profits in a 1031 exchange? Oh, Melissa, I think you're going to stump me. Yes, you can split it into 3 properties, and sometimes more. There's actually a provision to do that. I think the loan would be, I don't think it would be any different than any other loan. You would just go get a loan. And Melissa, if there's a chance you're asking me a question that's harder, I mean, it's deeper than I'm answering, and I apologize if I'm not answering it right. Mike says, Melissa, feel free to clarify or reach out to me offline since we're almost out of time. Dan Zoom says, I believe for a 1031, it has to make a profit. Yeah, that makes sense, Tech. Mike says, what's your name? It's Paul Moore. I'm just kidding. I was trying to think of a joke. My daughter's here, and she should be able to feed me some jokes, but she hasn't. Hannah, come on. Kevin Garcia says, what's a good market entry-level deal? I did work for Michael Blanc years ago. What area is a good market? Justin says, I disagree. Oh, with somebody else. Thank goodness. Oh, not me. I don't know the answer for that, but I would say I have 22 different criteria to evaluate a market. I'd look for a low unemployment, a diverse economic base, high barriers to entry. That's kind of hard because then you'd be squeezed out, right? I shouldn't have said that. Scratch that. Strike that. Reverse. But seriously, you're looking for net population migration, which is really high. That's my number one criteria for a new market. So go look up net population migration. That's the number of people moving into the area versus subtracting the number of people moving out. Austin, Houston, San Antonio, Dallas, Charlotte, Raleigh, Durham. Those come to mind right away. Other areas that don't come to mind are often in the north, which is where I'm from, and I have nothing against the north. And by the way, there's some huge growth in the north in certain pockets as well. Kevin, thank you so much for saying that. Ramsey says, that's okay unless it's house debt. I would pay off credit card debt. I think someone else is arguing. I hope it's not me here. Garrett says, since the 1031 is tax deferred, when do you pay the taxes on the property that you sold? At the end of the line. Okay, so when you finally don't do a 1031 exchange, let's say you 1031 exchange once, twice, three times a lady. Okay, let's say you do that 3 times. At the end, you decide not to do a 1031 exchange, you pay the tax right then. But guess what? If you do a 1031 exchange on the last time into a house that you wouldn't mind living in, 2 years later, according to what everybody tells me, I've never seen it in writing from the IRS, you can actually move into that house, okay? You can actually move into the house and never pay taxes. I told you, you can be a millionaire and never pay taxes. You thought I was kidding. And I told you there was a point. I finally figured out what the point was. You can be a millionaire and never pay taxes using a 1031 exchange. Another way to do it is die. Now, that wasn't meant to be funny. It's actually a very serious subject. But if you die and you don't sell the asset, it stays in your portfolio, your kids up to a certain point, or whoever your heirs are, can actually reset the basis to 0 and never pay those taxes that you never paid in all those 1031 exchanges. Now, who can give me a thumbs up for that? Who can give me a like for that? Who can give me a heart for that? Okay? We're going to be talking on probably Saturday, if Zach hasn't fired me by then, about, he's from Biggerpockets, by the way. He's an amazing guy. Thanks. Hearts. Thumbs up for Zach. But anyway, we're going to talk about 10 different ways to save huge on taxes if you're a real estate investor. By the way, the only other better tax class that I know of is investing in oil and gas, and it has incredible risk. And I would not recommend it. I lost a lot of money in oil and gas, but I'm not going to cry right now. Now, Elvis says, what are the barriers to entry to projects near in a city? Any books you recommend that outline big projects, 20-plus unit condo or buildings? Yeah. So I've got a book out there on Biggerpockets. I mean, it's you can read about it in my Biggerpockets profile. I'm not going to advertise that because there are probably better books out there. Steve Burgess, The Complete Guide to Buying and Selling Apartment Buildings. That's Berges. Steve Burgess. Brandon Turner loves that book. I love that book. Highly recommend it. Gabriel, says, so wait a second. If you get a property after someone dies, you don't pay capital gains. That's right. If it's handled right, you do not have to pay capital gains. Let's say that you did the strategy and you went from $100,000 and you kept investing. Let's say you owned the property, just to make it simple, okay? Now you've got $5 million in property and your basis in there is like zero, okay? I'm just using that as an example. So now you owe taxes on $5 million, right? No, if you die, and again, there may be exceptions to this. There may be a way to do it wrong. But if you die right, what am I talking about? If you die right, you leave the property to your heirs. They can have a reset of basis up to the $5 million. They sell it the next day for $5,001. They only pay taxes on the $1 gain. I'm sure this is right. I've checked it with CPAs. I've checked it with my tax strategist. By the way, if you don't have a great tax strategist, you need to get one. I've got an article on Biggerpockets. I started to say BP. Biggerpockets on why you need a tax strategist. A CPA is great. A CPA who is a tax strategist is even better. Okay, we can talk about that another day. Gabriel says any state. You can actually leave this to to a spouse without a reset in gain on this, Gabriel, and in 5 states. Okay, I can't tell you which ones, but there's 5 states, and CPAs and tax attorneys and all that know this. But there are 45 states, or excuse me, all 50 states where you can reset the gain at the time of your death. Okay, so it's getting to the top of the hour. It's actually 6 minutes after, and I am having so much fun. I'm going to keep going. Okay, so I'm going to look for another question here. Nana has a question. Hi from Ghana, Africa. Thank you so much for joining us. I'm super honored. We have height individuals that can invest from Africa. Oh, you have 8 individuals. Okay, Nana, I have more investors at Wellings Capital than we can even find deals for. But if you want to talk to me offline, I can maybe give you some ideas of other places you can invest. There's a podcast about investing in America. You might want to check that out. There's all kinds of things to do. Elvis says, what letters do those 5 states start and end with? Elvis, that's really good. Here's the problem. I don't know. I don't remember what the 5 states are. Someone told me Texas was one of them. So TS. No, seriously. I don't know. Someone told me Texas was one, but there are certain states you can do it. If you plan on dying and you want to leave your assets to your spouse with no capital gains, not just your kids, seriously, that is a way to do it, to invest in those 5 states. And like I said, a tax attorney or CPA should know. Okay, Neelafar. Yeah, I agree, man. All right. Financial investor, meet Kevin Hay. Okay, mentors need their money. Okay. Hey, Kevin. Okay, what else do we have here? Ashley says it didn't work for me. If the Biggerpockets Pro code I gave you did not work, I gave you a code Let's Invest, and I gave you a bunch of reasons to save money by getting on with Biggerpockets Pro. But if I gave you the wrong code, or if it doesn't work for you, please reach out to me. I promise I will get you an answer, even if it's not the answer you want to hear. I have no idea what that means, by the way. Let's Invest, one word, all caps. Try it. Hey, Kevin. Okay, so what else? I missed a bunch of questions earlier while I was rambling. And I was rambling. I could talk to you about swinging for the fences. I could talk to you about cryptocurrency. I could talk to you about all kinds of fun things, but I'm trying to stay focused on how to be a millionaire and pay as little taxes as possible. Justin Ramsey Conzo says, I have over $1 million in debt. I also live happily. You can be really happy with $1 million in debt. I had $2.5 million in debt one time, and I was debt-free 13 months later in the height of the recession by using WWGMD. Who can guess what WWGMD is? All right. I will get back to that when somebody ventures a guess. I live happily, $100,000 for a mentor. Yeah, Kevin, seriously, there's $100,000. It's a mastermind group, and it's really powerful, and the people in there are making hundreds and thousands and even millions of dollars, I promise. By the way, I shouldn't say I promise, but I know a few of those people, and they are. What's your experience with Michael Blanc? I know him, and I think he's great. I have not had him as a mentor. I had a mentor that cost $25,000, and that's much, much more than Michael charges from what I've heard. Thanks, Kevin. All right, 1031 is tax deferred. Okay, he speaks the truth. Hey, Jeff, I was one of those who reached out to him, and he's responded with more information as promised. Jeff, thanks for saying that. What is a good market entry level? Tried that one already. Okay, Elvis. Okay, got that. All right. So I'm a CPA, and what I advise everyone is pay off debt. Hey, Ramsey, you know what? I totally understand that. I really do. And honestly, I understand what you're saying. So Ruth says, what would a grandma do? WWGMD. Ruth, you're the winner. That's not, actually, I do have a grandma's rule. And my grandma rule is this: before we invest any money for ourselves or any investor, I'd say, if this was my grandmother's last $50,000, would I invest it in this deal? And if I wouldn't, it's not a deal I want to invest in. Okay, so that's the grandma rule. Ruth, I'm going to go ahead and give you the prize, but the actual meaning is, what would George Mueller do? That's Mueller. It's also spelled the MU with the dot over it. What the heck does that mean, by the way? So it's a German spelling. He goes by George Mueller. Well, he died, so he doesn't anymore. But he went by George Mueller, but it's George Mueller is how it's pronounced in English. He's an awesome guy, and I basically started giving outrageously and generously when we were $2.5 million in debt, and I was debt-free 13 months later. My daughter's in the room, and she can shout out and say, "That's true."
It's true.
Thank you. I paid her to say that. But no, seriously, it's really true. I did. What would George Mueller do? Check him out. Okay, I'm looking for a few more questions, and then we finally to be paid once the empire sells. Thanks, Roger. Pay off debt or start investing right away. Where do I start with a 1031? We already talked about that. How to be a billionaire. Okay. I am probably, that person who said, what do you charge? I was probably asking somebody else. So sorry for answering that. 1,200 years old. You forgot the interest on the interest, compound interest. If that was toward me. Oh, it's actually more money than I said? Okay. Well, that's great. All right. Well, mine was a simple calculation. It's all about risk tolerance and the interest rates. Yep. Okay. So we're going to wrap up. It is 7:13 Eastern time. It's 4:13 in California. Redding, California is where my daughter lives. And please remember to keep them in your thoughts and prayers, and pray that this windstorm and the firestorm dies down, and the city of Redding is spared. And there's a lot of other places, including Yosemite, out there that are having lots of trouble. So I'm going to try to answer a few more questions online here as we wrap up, but we're going to wrap up for today. So I want to thank you for joining me. I'm going to have another, Biggerpockets is having other episodes this week, and I'm going to have another one toward the end of the week about how to be a millionaire and never pay taxes. Oh, yeah, we talked about that. Well, I'm going to talk about how not to pay taxes anyway. There's 13. Did I say 10? There's 3 bonus strategies if you tune in live at Biggerpockets Live, and we're going to talk about, or YouTube or Facebook Live, we're going to talk about 13 ways real estate investors save on taxes. All right? Have a great day. It was great to see you. Thank you so much, and I hope you'll share this, and I hope you will come back again. Thanks.